Good day, legends. If you've started investing in shares or ETFs, tax time can feel a bit overwhelming, especially if it's your first year doing it. The good news? The Australian Taxation Office has detailed guidance to help you get it right. Let's start here, on the ATO's homepage. This article is aimed squarely at new investors. Assistant Commissioner Tim Lowe explains that the rise of micro-investment apps has brought a wave of first-time investors into the market, and many of them don't fully understand their tax obligations yet. Here's something worth knowing. The ATO already receives data from ASIC, brokers, exchanges, and share registries. That means a huge volume of transactions, millions of them, get automatically matched against tax returns. But that doesn't mean you're off the hook. It's still on you to check that all your information has actually been included before you lodge. One common mistake new investors make is misunderstanding paper losses. If the value of your shares drops but you haven't actually sold them, that's not a capital loss you can claim. The loss only counts once you dispose of the asset. The ATO's data analytics are sophisticated enough to catch people trying to offset a paper loss against real income, and penalties can apply. The takeaway here is simple: keep good records. Dates, prices, brokerage, dividends, share splits, mergers, all of it matters when tax time comes around. Now let's go a level deeper and look specifically at how ETFs, exchange-traded funds, are taxed. We'll head back to the homepage and search for that guidance directly. Here we are, the ATO's dedicated page on exchange-traded funds, tucked under individuals and families, then investments and assets, then shares, funds and trusts. This page covers everything from how ETFs work, right through to what you need to declare and how to calculate capital gains tax when you sell. So, how do ETFs actually work? An ETF is a managed fund you can buy and sell units in on an exchange, like the ASX. When you invest, you're buying units in a trust that holds the underlying assets. You don't own those assets directly yourself. The ATO uses a simple example to bring this to life. Mary wants to build a portfolio of ASX shares and commercial property, but doesn't have the time or confidence to manage it herself. So she invests in Blue ETF, which already holds the mix of companies and property she's after. By buying units in that ETF, Mary gets regular distributions of income from those underlying investments, without having to manage a portfolio directly. ETFs can hold a surprisingly wide range of assets: Australian and international shares, property, bonds, precious metals and commodities, foreign currency, even digital assets like crypto and non-fungible tokens, and units in other ETFs. This is the section that really matters at tax time. You need to declare any income your ETF pays out as a distribution, and importantly, even if you've chosen to reinvest that distribution instead of taking it as cash, it's still considered income and still needs to be declared. You'll also need to report any capital gain or loss when you sell or dispose of your ETF units. On the flip side, if your ETF invests in companies that have already paid tax in Australia, you may be able to claim franking credits. Your statement will show you exactly how much. Where does all this information actually come from? If you use MyTax, a lot of it will be pre-filled using data the ETF provides. But if it isn't pre-filled, you'll need your own statement, usually called a year-end or annual statement, a member statement, a standard distribution statement, or an attribution MIT member annual statement, depending on the fund. That statement tells you exactly what to report and where it goes in your return. If you've invested in a foreign-owned ETF, things work a little differently. These funds often don't provide a statement at all, so you'll need to rely on your own records. Distributed income from overseas ETFs counts as foreign income, and depending on the country and Australia's tax agreements, withholding tax may apply. If tax has been withheld, you may be able to claim a foreign income tax offset to avoid being taxed twice. Some ETFs let you reinvest your distributions automatically through a distribution reinvestment plan rather than receiving cash. Even though no money lands in your account, that reinvested amount is still assessable income, and it's assessable in the year it relates to, not necessarily the year it was paid. Those reinvested amounts also get added to your cost base, which matters later when you calculate capital gains. Whenever you sell or dispose of ETF units, whether that's a straightforward sale, gifting them, transferring them in a relationship breakdown, or even a buyback, merger, or liquidation, that triggers a capital gains tax event. To work out the gain or loss, you'll need to convert foreign amounts to Australian dollars if relevant, work out your cost base, identify exactly which units you're disposing of, and calculate the resulting gain or loss. And don't forget, Any capital losses from previous years can be used to offset future gains. Which brings us back to where we started. Good records make all of this so much easier. Hang on to the purchase and sale dates and prices, brokerage and other costs, the dates and amounts of any distributions, and details of any other CGT events like splits or mergers. Generally, you should keep these records for 5 years after the ATO processes your return. It might feel like a lot at first, but the ATO's website breaks all of this down clearly, and once you understand the basics, staying on top of your ETF tax obligations each year becomes second nature. But remember, this is general education, not financial advice. Always make sure a strategy aligns with your personal risk tolerance. Let me know your core ETF holding in the comments below. Hit subscribe if you found this helpful, and I'll see you in the next video.